Okay, quick weekend market update. In this weekend's video, I'm just going to cover the concept of a generational market top. I'm just going to throw it out there. Never heard it mentioned before. Chatted about it a few times with a few people during the week. And it probably sounds crazy. You know, I have absolutely no clue where the market's going from here. But, you know, the market will do whatever it wants to do and it will surprise everyone. So I thought what I'll do is I'll just rewind back to a market we saw. I didn't see it because I wasn't alive then, but back in 1929 when the market topped. History does not tell you what's going to happen in the future. It will show you what's happened previously in the future, but it's a pretty good exercise, you know, just to know what to expect. And I say know what to expect, you know, think the future could be twice as bad. It doesn't mean, you know, because it's not happened in the past does not mean it cannot happen in the future. You know, we're seeing that with, you know, the pandemic we've got at the moment. So I'm just going to fast forward as fast as I can this market crash from 1929, and saying things again, you know, markets tend to crash after you get the normal. You'll get into correction territory and then you'll see the volatility of these bars getting wider in the right hand side. And I'll just kind of highlight that. See how volatile these bars are. These are the crash bars, and the market's already, you know, it's already off 20% before we go into this unbelievable sort of big range bars down here. So I'll try not to go into the stop loss debate because a lot of people will just go, stops don't work, and it's pointless me even trying to explain that. But what I will do is I'll just point you to a video I did the day before the market started pulling back into the first pullback, what turned into a crash of this move. The video was called Time in the Market or Timing the Market, and I do something what's neither of those. I just measure how bullish the market is, and my risk is unwound by the market. So by unwinding my risk to that market environment, I'm fully in cash. I'm down a very tiny amount on the year, and as a trend follower, you know, I'm a kind of systematic investor, but when it comes to managing my trades, I call it trend mode. You know, I've got my own methods, but my market model overrides all methods, and that pulled me out of the market. You know, I sit through every pullback. The occasional whipsaw whale get chopped out of a weak stock is very normal, but the market, you know, the risk management underpinning everything I do is for the one scenario what you really have to avoid, the full-on market rug pull. So for those who are interested in that video, it's called Time in the Market or Timing the Market, and it was loaded on the 23rd of February 2020. So what I'm going to do here is we've got a very similar pullback on the Dow Jones. It doesn't matter what market I put in here, but this is, you know, and I'm just going to fast forward through, and I'm going to quickly just show you that, you know, pullbacks, volatile markets are going to have throwbacks, and I'll do the same thing I always do. I'll just say, supply, not as meaningful as stock supply, because futures tend not to sort of have long-term investors in like stocks do, and people like to get near break even on stocks, and that's why the supply on stocks tends to be extremely like a reverse pole on a magnet. They're just very obvious, meaningful levels on indexes, and the 50% area is an extremely normal area for the market to bounce to, and it does not change the structure of the price action either. And a lot of people will say, well, this isn't a true bear market until it takes the lows out. And in price action terms, yeah, I probably agree with that. But a 30-odd% absolute market crash is hard not to call a bear market, isn't it? But when it comes to price action, you will see what can happen. And I'll say again, that the best thing will be the market goes all the way back up to highs and then bases out off highs. I'm not trying to sort of say what's going to happen in the future. What I am trying to say is, this is what you have to protect yourself. I had money running into the tech bubble. I had money running into the GFC. Now, if you haven't had money running, and I was lucky to sort of be in Indonesia when the pullback in 2010 happened. I got caught getting back too early into one of those sustained sort of bear markets, and I learned a few lessons there. But even in 2011, it was an absolutely awful market. Good thing with awful markets and really bad rug pulls is great markets do follow, but the stocks usually just take a bit of time to sort themselves out. The trends take a bit of time to sort themselves out. In the meantime, it's generally a game of dead cat bounces, wild swings. The best scenario is it went straight back to highs. It really doesn't matter for my methodology, because I allocate risk as per the video I told you, and I only take positions in the best stocks I can find. So I'm just going to buzz forward through this, and nobody knows where we are in this market, but there is the very real potential that we're actually here. And this isn't a I think I'm better. I'm not. I'm always neutral. I just allocate risk. At the moment the trend model's virtually bouncing on zero. I have no risk to allocate. It's a simple thing. But what I'm going to just show here is what can happen. So let's just zoom this out. 25 years to recover. Now, in the UK, a lot of us like to sort of ride the AIM stocks because we get some pretty high beta movers in there, and you've got to, if you haven't done the work, in looking at the survivorship bias. The mark, you're going to think that, these stocks in the AIM market are going to be fine. I'll just, I'm going to ride it back out until I get to break even. So, I show the extreme case because that's the only case I really have to protect my account from, the worst case scenario. And I'm pretty sure, there's a chance I might still be on the planet in 25 years, but I'm not sure. I certainly don't want my money tied up for the next 25 years before I start making new portfolio highs again. So, that's just not something I want to go through. I can tell you now that, if you went back into any market bear leg and go and have a look at how many companies went bankrupt, whatever, that's an important thing to sort of look at as well. So, this is just a video what explains what can be in front of you and why you should know what you're dealing with. It's not my way or the highway. I'm just, and this is a market what recovered. So the thought, the concept of the generational top. What if you had this action and the market never did recover? Well, all of this is tradable. All of this is tradable. But if you're fully invested and you lose money and stocks go bankrupt, and I'll tell you now, as soon as you go down to the AIM markets, you want to have a look at those delisted stocks and really have a think about what you would hold into a bear market. It's extremely important. And a lot of people will tell you that, you can just hang on and your account will recover. You've always got to be open to the. I think the basic way to put it is, if you need to sit through a huge bear market without taking any action whatsoever, and you think that you're just going to recover over time, it's actually pointless. It kind of defies the object of being a trading. You might as well put your money in a tracker, I suppose. It's the way to think about it. It's kind of, what's the point? So there's always the potential. We are here. People will say the markets cannot trade, different markets say it doesn't matter. We never know what's in front. We just don't know. I'm in cash. I will nibble at any idea. If the market improves, I will start to nibble at ideas what fit my criteria again. And all the stocks I nibble at will be structurally. I don't want to buy anything cheap. I want to buy something what's structurally sound, got a reason to go up, growth, and has got no overhead supply. So, I want to buy stocks at highs. I don't want to be buying stocks what are still in the downtrend and that money being trapped. So as soon as the market sort of starts to throw out those stocks, and I will find those stocks even in bullish rallies in a bear market, they will crop up. But it's just something it's just unbelievable that I did that video the day before the market sold off, talking about how I would unwind for the market scenario. I stay long until the market model takes me out. The market model takes me out, and this is the reality of investing, and what can happen. Doesn't matter what anyone thinks will happen. You've just got to be at one with what can happen, and you've got to make that decision, and you've got to stomach it over the long term if you decide to take that route. So everyone has a stop in the market. I tend to put my an order in where I'm wrong on a stock. Other people will have different ideas where their stop is. It will be basically they need the money for something else. They've taken too much pain. Everyone has a threshold where they will dump positions, and it's a fine line between market correction and bear leg or crash. It's a little sort of calculation what involves a few whipsaws. That's normal, but I'm going to quote my friend Murray again. Rather be whipsawed than be chainsawed. And that's just something we've got to think about. If you haven't had money in the markets through a bad market environment, just make sure you go back and have a look at what markets actually can do. So, not as quick as I thought it was going to be. I'll leave it there.